You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Richard Brennan and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, I hope that today's episode will trigger your curiosity enough to check out the back catalogue and listen to the past episodes you may have missed, like my conversation with Alan last week, where we discussed the return dispersion among trend followers in August, why all you need is trend following, as Quantica recently concluded, and of course some of the key new items, or news items is what I meant to say, from Jackson Hole. Also, I would encourage you to listen to the midweek episode where Alan spoke to Cameron Dawson, the CIO at New Edge Wealth, and where they covered the earning situations as it looks like today, the tightening of liquidity that the Fed is doing, and why bubbles are the best source of returns. That is, if you get out in time. So head over and check it out after you've done listening to Rich and I today. Rich, as always, fantastic to be back with you this week. How are you doing? How are things down under?
It's a pretty sad time for us down here in the Commonwealth nation of Australia. We've lost our Queen, so it's been a pretty miserable day for me over the last 24 hours. A lot of us over here, we've got very favourable sort of memories of and fond memories of the Queen. She certainly made it over here many times, and I'm particularly attached to the monarchy, so I'm a bit upset at the moment. But apart from that, Niels, trends are going well, so there's always that to lift my spirits.
Absolutely, and of course, it is a big loss for the UK, and in fact, I'm heading over to the UK in a couple of days, so I will be experiencing the somber mood, without a doubt, in London, but also have a chance to remember the Queen a little bit closer. Now, let's dive into, actually another somber note, frankly, because before we get into this week's sort of what happened, I did notice a conversation that came out, I think about 10 days ago, with the historian Niall Ferguson, who warned that the world is sleepwalking into an area of political and economic upheaval akin to the 1970s, but he says it's only worse. And so I found a snippet of what he said on CNBC, and so I'm quoting now. He said, "I said, having listened to Professor Stiglitz say that there was no inflation, that we would actually be worried and that there was a risk of a 1970s scenario. And I said, if there was a war," and remember, this is a year ago, "that's when you get inflation expectations really take off. Well, we got the war in Ukraine, and we also have the risk of instability elsewhere, not least Taiwan, between the US and China. So the ingredients of the 1970s are already in place. The monetary and fiscal policy mistakes of last year, which sets the inflation off, are very like the mistakes of the 1960s. And then, as in 1973, you get a war, except this war is lasting much longer than in 1973, and the energy shock that it's causing is actually going to be more sustained. So the question that I'm asking, are we sure it's not going to be worse than that? I mean, most people, when you have this conversation, kind of assume it can't be that bad, and they can't really envision double-digit inflation in the US. But we already have that within the UK, and the numbers of countries with double-digit inflation in the world is already north of 40, and it will soon be a higher number than that. And so I ask myself, why shouldn't it be as bad in the 1970s? Why shouldn't it actually be worse? I don't know if you have any thoughts on that before I do my normal market wrap, but I thought that was a particularly somber note.
It is, but I think we can't lose sight of the fact that often, we talk about things in economic terms, but as we all know on this planet, there's a link between the economic, the environmental, and particularly the social fabric of this world. Now, I'm particularly worried about the decohesion of the social fabric. I think that the symptoms we are seeing, because we are in this complex adaptive system, the things we see at the economic level, they flow through into all of these different legs of stability in the global economy and our globe. And so I do worry about our ability to retain a level of social cohesion. I think post-war, post-1945, up to 2000, I think we did have a blossoming period where everybody was doing well. Generally, there was rising inequality, but generally there was this everyone working together cohesively as a whole. There was less, I think, social unrest, but I personally think that now the situation is ripe for social unrest to really sort of rear its ugly head. I think we're seeing this symptomatically with Ukraine and Russia. I think we're seeing this with Brexit. I think we're seeing this with the fractionalisation of the US people into those that support Republicans, those that support Democrats, the Trump, etc., Biden sort of rift. So I do see this level of unrest building, and I think this is symptomatic of all of the factors that come to play in making people either feel safe and secure or whether it makes people feel uncertain. And I think we are in an environment of uncertainty, and I'd be really watching for this blossoming of social unrest, which I think is the next thing to basically cause a lot of mischief in keeping this world cohesive and united.
Yeah, no, absolutely. All right, well, before we get to the trend following part, let me just quickly update everyone on what kind of the key points, what happened this week. And of course, as it has been for a while now, it's pretty US interest rate focused. But I think with regards to the Fed's action on overnight rates, analysts have been waiting to see how consumers reacted to the July rate hike as the summer progressed. And many expected that high gas prices along with a broad-based inflation would slow consumer demand enough that the Fed would, at the very least, moderate further rate hikes, possibly even pause for a meeting or two. But instead, the Fed, via the Wall Street Journal, communicated this week that another 75 basis points hike is likely when it meets on September 21st. The various members of the Open Market Committee have all aligned as hawkish and have left open the possibility of another 75 basis points at the November meeting. That would push the overnight corridor to about 3.25% to 4% by November 2nd. And in previous communications, the Fed suggested that the target rate was 3.5% to 4%. So that would be on the somewhat restrictive side. Now, stock investors didn't seem to mind and to be too concerned about this, as the sentiment brightened a bit, and the S&P this week snapped a 3-week losing streak to finish up 2.84% so far for the month. And also in terms of volatility, we actually saw the VIX heading back towards the 20 area. So a little bit of action there. But as usual, Rich, let me just turn to you again and just hear what from the world of markets, economics, trend following, whatever you choose, that you've been focusing on since we last spoke about a month ago. I hope the battleship is doing super well. Maybe it's even a speedboat at this time. Who knows? But how are things looking from your side?
Look, it's July, of course, was a hiccup month for me, but we had a big resurgence in August. And so I'm back at my high water marks now. This particular month, even though we've only had about 10 days of it, has been particularly strong for me. I think what's really sort of saving my portfolio is this exposure to Japanese yen. We're getting these trends that we've had that really started in the 20s, they're spectacular trends, and I certainly can't see any signs of it cooling down. So USD, JPY, the Swiss yen relationship, they're very powerful contributors to my portfolio. So, in last month, I particularly had a bit of a decline in my energies, spot Brent, spot crude. I took a bit of a bath there, but the powerful performance of the yen pairs certainly made up for that, that impact of the energy exposure, more than what I lost on those. So the portfolio is doing very well, but it's a very unusual environment. I'm certainly not suggesting that this we can expect this forever, but it's a fantastic environment for trend following. I just, at the moment, I think that all the conditions are ripe for this to continue, but let's see what happens.
Absolutely. Certainly from a trend following, point of view, currencies have been a really interesting sector lately. But of course, for this week, like a few of the recent weeks, it's really been fixed income that has been the dominating factor. Bonds and shorter term interest rates have been, bonds have been heading down. Short-term interest rates have been heading up in terms of yield. And I think a lot of trend followers still benefit from that. Other sectors that I just looked at quickly, I don't think there's too much action going on, except, as you say, in some of the individual currencies. And maybe even, I think maybe cocoa. There was one of these soft markets that I noticed actually looked like it had a good week from a trend following perspective. So anyways, not much really to talk about on that. But as you alluded to, it is a positive start to September. This is numbers as of Thursday. I do think yesterday potentially could have been a little bit of a losing or at least a mixed day for CTAs. But Beta 50 index is up 61 basis points for September, up 15.4 for the year. SocGen CT index up 40 basis points, up 21.3 quarters. For the year, SocGen trend up 70 basis points, up 29.08 for the year. And the short-term traders index up 45 basis points, up 11.5 or so. For the year, while we see that the MSCI World Index is also enjoying a good month, up 2.12%, but still down almost 17% for the year. And the World Government Bond Index, it just continues to drop in price. Last week, we could confirm that, at least in the US, we had the first official bear market in bonds for a few decades at least. And the World Government Bond Index is also down so far this month, about 96 basis points when I looked at it. All right, let's dive into some of the... we have one question before we dive into the topics, which are super interesting topics today, I have to say. So thanks so much, Rich, for preparing all of that. But the question that I want to pose from you is from Irving. And Irving writes, "Hello, Niels. Your podcast, particularly the episodes with Jerry and Rich, motivated me to develop my version of the turtle system. I very much value the knowledge you provide week after week." Well, that's very kind of you to say, Irving. Anyways, during backtesting, two questions popped up. First, the use of ATR, so average true range, for position sizing is straightforward. But ATR of what period? The same as the trend, question mark. Second, is it the same trend length for entering and exiting, question mark? Or is the exit length somewhat lesser than the entry? Appreciate your comments about this. Thanks in advance. Take care of yourself. So now, of course, Rich, I know you are very transparent, but of course, we don't expect you to reveal the secret source of how you do things. So if you can talk to Irving about these questions with that in mind, feel free.
Yes, so it was a good question from Irving. And look, I firstly want to congratulate him for having a crack at the turtle trading method. A lot of people say that the turtle trading method doesn't work anymore, but really they're taking a literalist interpretation about the specific variables that were used for the turtle trading system. But, given that markets are these adaptive things, the variables do change, but the system itself is still very valid, particularly these simple trend following systems like the turtle traders method. When you've only got a few parameters, such as the entry condition, the initial stop and the trailing stop, when it's a very simple trend following system, you tend to find that these things are universally applicable across markets, and they're very sort of robust because of the limited number of parameters. But what you do need to recognise is that the variables you use for those parameters do need to alter over the course of time. So whilst people say that the turtles trading method doesn't work, well, literally, if you used exactly the same variables that the turtles did back in those in the 80s, you would find that. But you can certainly use the turtles trading system with variables that adapt over the course of time, with the nature of how the market changes, to have these robust models that are very enduring in nature, which is different to more complex models that are developed with many parameters that are specifically configured to respond to a particular market condition. They're not universally applicable, they're fit to a particular market condition. And what you find with those complex models is that when that condition changes, you can't just change the variables, you need to drop the entire system and develop a new system. So where our simple trend following models work well is that they are universally applicable, they are very enduring. We don't need to drop those systems, but we do need to adjust the variables from time to time based on how the market evolves. So congrats to Irving for having a crack at the turtles trading method. In relation to his questions on ATR, look, a lot of trend followers do things differently, so I'll just explain how I do it. So I use an ATR with a 25-day look back. That therefore means that I'm looking at volatility over the last 25 days using fairly recent data. I then also apply a multiplier to this ATR. So over a 25-day period, I have an average true range of X, and then I will apply a multiplier to that 2 times, 3 times, 4 times, or whatever. And the use of the ATR and the multiplier is used to define my initial stops and trailing stops, and also for my position sizing. So as you know, I don't practice the principles of dynamic position sizing. So on entry into a particular trend for a particular system, I'm using my ATR and my multiple to define the initial stop for my initial bet allocation. That bet allocation in terms of position size stays constant from entry right through to exit, but at the point of entry is when the calculation is performed, so that I apply an equal risk bet based on my realized capital. So what I'm saying at that point of time of entry into a trend, before I actually participate in a trend, just when the signal arises and I'm just about to enter that trend, I do have known information that I can rely on. I know how much my realized capital is at that particular time. In other words, the trading level based on all closed trades at that particular point in time. I know the volatility up at that particular point in time, and that is sufficient information to allow me to assign a standard dollar risk bet based on my realized trading capital. So at that point, when I use my ATR and my ATR multiple, I define a stop position. That therefore gives me, that stop position effectively is my amount of risk on realized trading capital I'm prepared to take for that trade. In other words, let's say I have a $1,000 risk bet based on a realized trading capital of say $100,000. Therefore, I might be assigning, I think it's 1% at that particular level, $1,000. Let's say it's $500. That therefore says on my realized trading capital of $100,000, I'm prepared to bet $500, full stop. I therefore define where my initial stop is using ATR and ATR multiple, and that therefore says between the distance of entry and to that position of the initial stop, I only want to risk a maximum of $500 on my realized capital. Then the trailing stop takes over from that point of time until exit. Now, I'm using the same ATR multiple of ATR period of 25 days, and I'm using the same multiple for my trailing stop as my initial stop. But every time the price moves favorably, in accordance with the direction I'm taking on that trend, the trailing stop lifts up or ratchets up using recent volatility. So it will expand and contract with different levels of volatility. But what you'll find is that it never goes backwards. So I find that on my initial bet of $500, that is the maximum adverse exposure I'm prepared to take on my realised capital. And then when the trade takes off from entry to exit, as soon as it moves favourably, I get a favourable move in my trailing stop. If it goes unfavourable, the trailing stop locks in place. It's what you call a chandelier exit. So it doesn't sort of lower. In other words, I'm not giving back. My trailing stop always locks in place if there's an adverse price move, but when there's a beneficial price move, it always moves in that direction. So what that means is that over the course of time, I can find that price moves significantly away from where my trailing stop level is. If there's a very fast, positive, beneficial trend movement, price can accelerate away from my trailing condition. Now, what that means is that I'm not risking there my unrealized, I'm not risking there my realized trading capital, as that was already assigned on entry, but I am risking significant amounts of what I call unrealized equity. Now, because I'm in the camp that says I allow profits to run, I believe that this is an okay risk bet for me to take. I'm not risking my trading capital that I'm preserving at all possible costs. That's what I want to preserve. But I am risking my profits. In other words, if I do build up a level of unrealized equity or significant profit there, I'm prepared to risk that for significantly greater profits in the future because I don't know what the future is going to hold. So that's the thing about as soon as you enter a trend, you don't know how long that's going to last. So when you say, do you use an ATR based on the size of the trend length? Well, we don't know how long that trend's going to be. So, when you enter a trend, you need to use a 25, something like a 20 or a 25 period ATR to look at the recent volatility, because that means that as volatility increases, your trailing stop gives you more room to breathe. Now, I'm using volatility basically as a basis to allow my trailing stops to give room to breathe. I'm not using my ATR as a basis to define dynamic position sizing between the entry and the exit. So what I'm saying is that when you use dynamic position sizing, you are changing the allocation of your position between entry to exit in terms of its position size. So really what you're doing there is applying a degree of leverage, either increased leverage or lower leverage, to massage the position size in accordance with the volatility. That's different to what I do. I'm using ATR of my volatility measure simply as a means to define breathing room for my trends to move. I'm not changing my position size. So I'm keeping my position size constant, but I am giving more room to breathe. And this is sort of consistent with my philosophy of allow profits to run, give maximum freedom for profits to run. If you are risking profit, don't worry. Risk that profit to achieve far greater profits. But if you are risking trading capital, be very careful with risking that level. So that's my preference, Niels. Does that explain things from my perspective?
Yeah, but you've opened up the kimono a little bit, so I have a couple of follow-up questions, actually. So if I understand you correctly, let's just say we take a simple example. Let's just take the dollar index, right? And let's just say you get a long position at 109 and you do your calculations of ATR, let's just say whatever the volatility is on that day. And let's just say, so you set your stop accordingly, but let's just say the market then moves up in your favor. It goes from 110 to 115. I imagine then, and let's just for argument's sake say the volatility is unchanged. So I imagine your stop would move up having the same distance, but this time from 115. So essentially it moves higher only with the price move. But my question becomes, what if the price then stays at 115 and volatility drops? And let's just say volatility halves. I'm interpreting what you said is that you would then move up your stop to about half, all things being equal, to about half the distance from the 115 where the price now is kind of stuck. Is that correctly interpreted?
Yes. So because I'm using a 25 period ATR on my trailing stop, what you do find is, let's say that volatility, volatility, let's say, decreases. So, but let's say that price has moved in my favour. If price has moved in my favour and volatility decreases, yes, my trailing stop will ratchet up in relation to that reduced volatility it's now experiencing, because it's using a 25-period look back. If so, yes, that.
Okay, so let me just continue my thought experiment here. So let's just say, again, take a simple example. You get in at 110, and let's just say the stop was at 90. Price now moves to 115. Volatility drops by half. So instead of, and this is, simple math here. So instead of 20 big points between your entry and your stop, we should now only have 10 big points. So it moves up to 105. So 10 below 115. Now, from what you said, as far as I could understand, is that even if vol increases again, you're not going to move your stop down from 105 now because it's locked in. Okay, and you're nodding. People can't see this. You're nodding. So here is my point. Because you and Jerry, of course, have been very vocal about the dynamic position sizing, right? And you just said before about leverage inside the dynamic position size systems. But in a sense, I would argue that you are changing to some extent the leverage, because your losses now, your potential loss is becoming smaller, and you're not going to increase that, you just said. So in a roundabout way, I think you are, I wouldn't say dynamically position sizing, but you're dynamically changing your risk in that trade. Is that a fair assessment?
Yeah, that's fair. But what we're not doing is incorporating additional trading costs. So
no, I'm not. I'm not attacking you here. I'm just saying.
So no, I agree. Leverage does change. Theoretically, to stop, when you're looking at the distance from the entry to the stop, yes, that does change. With reduced volatility, it gets closer. If provided price is moving in your favour. Of course, all bets are up. As soon as price moves against us, between entry and exit, because I know Jerry doesn't use a chandelier exit mechanism. He's made that explicit. I do. So what I'm doing is, if price is adverse along excursion between entry to exit, I'm not adjusting my trailing stop whatsoever. The only time I'm doing this is in a beneficial price movement. So what it's doing is it's continuously massaging things, because in reality, I don't want to leave too much profit on the table when the trends decide to turn. I think I'm more aggressive than Jerry is with my chandelier exit in locking in more of that unrealized profit through the use of the trail. I'm not quite as freewheeling as, say, Jerry is, because I've got much lower capital than Jerry, and I think the difference in levels of trading capital really does change the philosophy in a lot of aspects, but that's getting onto another topic. So
but it's
I
very
agree with you, Neil.
It's very interesting because we've always talked about, and this is actually, I only bring this up because this is the first time I'm actually really appreciating the difference, because I kind of thought, because you both talk about, it's great to have loose pants, but your pants are not as loose as Jerry's, it seems, not at all times at least. So I'm now starting to appreciate the difference.
If you look at Jerry's, I'm using an ATR-based trailing stop. I think Jerry is using a Donchian-based exit. So if you look at the way a Donchian channel works, you tend to find that it does work like a chandelier exit in a lot of aspects.
True.
But there are certain things. ATR is a bit more responsive to volatility than a Donchian channel with a longer look back. So this is where Jerry and I will sort of have slightly different opinions here. Now, it's not that we disagree, it's just that we're using different systems. So,
No, of course. Yeah. And this is not about that. It was just a very subtle, when you explained it, I thought, well, hang on, there's actually a subtle difference here that I just want to make sure I fully understand. And so I appreciate I appreciate you explaining that, and which I think makes sense.
Actually,
cool.
I was just thinking, Niels, just quickly on that. Look, another thing that I think that I probably do differ with Jerry a fair bit is for instance, I know people say, I certainly say I don't use the dynamic position sizing, but what I'm saying there is that I'm not using dynamic position sizing for a single return stream, but I do use an ensemble of systems. But each of my individual systems in my ensemble has a fixed risk bet at entry. Now, the reason for that is because I'm of the opinion that because I'm targeting these tail regions where I think the information is deficient to be able to at least get sufficient information from that tail region to make an assessment of how to adjust position sizing, so I don't do it. So therefore, but I am applying an ensemble of systems at the point of entry with all different unique sort of configurations to capture different aspects of trends. So, that's where a person might say, well, Richard, you might not apply dynamic position sizing, but aren't you really doing that because you're using an ensemble of systems? You might use 6 to 8 systems. They'll be different at different points in time. They'll be turned on, and that therefore at a position sizing level will mean that on that particular market you will be increasing your position size. And yes, that is valid, but there is nuance in what I'm saying here because I'm not looking at assigning risk to a single trajectory. So what I mean is that the trends that can manifest in the tail region can be a variety of different forms. I'm therefore not prepared to invest a single bet, which is constrained by a particular system I used, or to over-invest in that particular trajectory. I'd prefer to spread my risk across an ensemble of 6 different configured systems to therefore diversify my risk across 6 different possible trend trajectories. So it's not what I would call over-investing or under-investing in a particular return stream, and therefore at the portfolio level, it keeps all of my risk constant because I'm applying the same risk bet across a diversified ensemble, across a diversified market landscape. You'll find that every return stream in that portfolio is fairly equally weighted, and it's not over-investing. But when I say equally weighted, it's equally weighted in respect to realised trading capital. It's not equally rated in relation to equity because some of those return streams carry a lot of profit in them, and there is a considerable distance to their trailing stop. So in terms of equity, yes, I can find that my portfolio is overweight, but it's overweight in risking profit. It's not overweight in risking my trading capital. Does that make sense?
Yeah, no, I mean, this is great. This is super. Now, there is one little place where I would like to push back on your initial comment to Irving, and that is, you kind of made it sound like that the traditional turtle type philosophy and similar systems, which, by the way, I don't, you and I had this discussion off air that people often say that it's simple trend following. But when we use the word simple, we don't mean easy or, in any negative shape or form, but maybe we just can't come up with a better word. But then you said, but if you use more advanced or whatever sophisticated types of trend following, you risk the fact that when markets evolve over time, you kind of need to ditch the whole system rather than just change your parameters. And I would push back on that because I actually think that there are many different types of trend following models that are maybe a little bit more sophisticated than one entry, one exit, and one stop, where you clearly don't need to ditch the system because it's the same approach, it's the same philosophy, it's the same core principles that we are applying. But then again, for sure, your parameters may be, out of shape, out of favor, and you need to recalibrate. I mean, this is one thing that we do at Dunn. I mean, we do have a dynamic process for selecting parameters, which I'm sure other firms would have as well. But it doesn't mean we're going to have to ditch any of our models just because the parameters change over time. So I just wanted to make that clear that it's, But I also, but I do agree that if you overcomplicate your system with all sorts of things that we can't really call trend following, then you do run the risk that model needs to be retired at some point.
Yes, I wasn't actually having a crack at anyone in the trend following world, and I know there's a lot of variation in system in the trend following world. What this is saying is that it's a bit like the difference between a four-wheel drive and a Bugatti Veyron. I can drive a Bugatti Veyron at high speed on a very smooth freeway, and I can, if you try taking that Bugatti Veyron off-road, you'll find that its performance is going to be significantly worse than what you got on that specific regime where it flourished. So that's what I'm talking about in relation to complexity. As you increase complexity, you are making your system more responsive to a particular market condition and less robust to a variety of different market conditions, simply because of the complex foundation of your system is restricting its abilities to accept risk. So when I talk about simple systems, I'm actually not having a go at simplicity. I'm saying this is actually very beneficial in uncertainty because I think people often equate simplicity with dumb. I actually equate simplicity in terms of the word parsimony or Occam's razor. In other words, I believe that simple solutions often are the most universally applicable solutions. And when you see the history of science and you see how we started off with these mathematical equations to define different theories, you find that as science progresses and you get more and more of these universal basically bringing together disparate areas of science into a cohesive whole, you find that the statements to express that science actually get simpler. They don't get more complex. Simplicity explains more than what complexity does. So in dealing with complex markets, which we all recognise are fiends to deal with, you actually you want simplicity because that is the most robust solution to deal with that level of complexity. And that's where I think a lot of people get it wrong in assuming that they should add more bells and whistles to their systems to target a particular aspect of a complex adaptive system. And yet we know that system is going to change over time. It's non-stationary. You really should be looking at robust solutions that are universally applicable, therefore simple systems, as opposed to ephemeral, fleeting, complex systems that might apply for a particular point in time and then no longer work. Because then what you find is you've got to what they call system hop. And system hopping is really problematic because that brings into the question of timing risk. If you have a model that suddenly no longer works and you develop a new model responding to what now does work in that regime, you're battling a timing decision, especially with these models that have a very short time frame or endurance. Universal models that can be applied at all times, that, they might offer, subpar performance during a lot of these times, but they don't die. These more complex, refined models are particularly honed for a particular condition, and where the risk builds up is that when that condition changes, these don't just underperform, they die. And this is where you get this risk of ruin arising. So that's what we're talking about here.
Yeah, no, absolutely. And my God, we've already covered a lot of ground and we're still only with the first question here, and we need to get to the topics. But I do want to say, just to really underscore, when we say simplify and so on and so forth, I actually think that is the hardest thing we do, and probably also other people who build systems, is actually taking a somewhat complex thesis and put that into simple rules, or simplify it into rules. So no, we hail simplicity as something extremely positive and valuable, because I agree with everything you said about the the properties of simplicity and the robustness, so on and so forth. But we need to stop there because we've got a few really important topics to discuss today. And so the first one, and actually we've already touched on some of these items, so it's quite nice. It's going to fit into some of the things we're going to talk about now. But the first one is, you wrote a headline to me saying that, we know that the 60-40 portfolio is languishing this year, but can we do better than that, right? So I want you to take the floor and talk about some of the things that we believe strongly can help investors who are stuck in the mindset that 60-40 is the way to go.
Yes, Neil. So, look, I don't want to regurgitate what you and Alan already spoke about last Saturday with
Sure.
Quantica's paper, but I did really enjoy that Quantica's paper. It's Quantica's Quarterly Insights for 30th of August 2022. And what their paper demonstrated was that the power of trend following as a diversifier is quite phenomenal, really, when it all boils down to it. And there are three particular points that Quantica hammer home in their research piece. And the first is that over a sufficiently long time horizon, the addition of trend following improves the risk-adjusted returns of almost all forms of investment portfolio. Now, we need to take this carefully because this is a bold statement here, because what this is saying is it's not just an equity portfolio it's going to improve, it's not just a bond portfolio it's going to improve. What Quantica is saying there is that it improves almost all forms of investment portfolio. And what they're saying is that the portfolio diversification benefits of trend following is independent to the underlying portfolio structure. So if we break this down, what does this mean? Well, we always know that trend following offers an uncorrelated opportunity for alternative portfolios. So let's examine that. When you look at what does a diversified systematic trend follower do, they diversify widely across asset classes globally and across systems, so that inherently whatever they are adding to as far as an allocation into a portfolio, they will be uncorrelated to whatever they're adding to by virtue of the fact that they are so extensively diversified. So this is an amazing, very powerful property that gives value not just to equity portfolios, not just to bond portfolios, but to any portfolio that is particularly concentrated towards a single specific risk factor. So if we, imagine long GDP portfolios, what do we mean by that? Well, whilst people might think that their portfolios are diversified, when they back and they look at is it really diversified? What they might find is that it is inherently exposed to what we call long GDP. So if I have a portfolio invested heavily in equities, a buy and hold portfolio, plus if I've got a portfolio invested heavily in property, what we're talking here, real estate, what you find is that those two are very correlated to long GDP scenarios. In other words, when the global economies are booming, both are fairly highly correlated to that. And what you find when you look into the broad causal mechanics of any portfolio that is allocated towards a specific risk factor, you find that they are particularly concentrated. Now, so therefore, when you bring a diversified trend-following portfolio with all of its properties into that investment portfolio, you significantly decorrelate that relationship. So you improve the risk-adjusted returns of that portfolio by virtue of you adding that effectively ensemble of diversification into your fairly concentrated investment portfolio. So that's the first point of Quantica. Does that make sense, Niels?
Yeah, makes perfect sense. Absolutely.
And the next strong point they make is that this isn't just a long-term measure, because they used a short-term rolling window, a 5-year rolling window, and they found that trend-following diversification benefits are persistent over time, plus they have been strongest when needed. And what that means is that when these portfolios that are particularly concentrated towards a particular risk factor are underperforming, that's when you find that the uncorrelated nature of the trend following component that's added into that portfolio actually adds this cushioning, this protective cushioning that dilutes the impact of that adversity of that concentrated portfolio. And the third point they like to make is that the benefits offered by trend following is to a large extent resilient to degradation of trend following returns. And that's because they're saying that it is the uncorrelated diversification benefits of trend following that is providing the benefits. It's not really the actual underlying performance of that trend following model which is augmenting the returns. However, what I did was I took up the challenge of Quantica and I did my own research, because I totally agreed with them on all 3 points, except that third point where I thought, well, actually, you can find that trend following augments returns, improves the compound annual growth rate of the portfolio. This is something that in this statement that it is not, we can have a degradation of trend following returns but still obtain these benefits. I don't think Quantica is actually saying that it doesn't improve returns. I'm just thinking they're saying that, look, you don't necessarily need enhanced returns for trend following to still obtain these benefits. So I'll give them the benefit of the doubt here. But I did my own research and I particularly looked at an equity portfolio. And particularly, I looked at the traditional 60 equity 40 bond portfolio and looked at, well, what component of trend could we replace with that bond? And also, is it a 60-40 relationship, or is there a more optimal weighting when you incorporate trend following into your equity portfolio? And when I did this research, I noticed that, of course, everyone's fully aware that when you look at the period from 2000 through to 2000, where we are now, 2022, there's effectively been 5 periods of equity correction. So there was the 2000 to 2003 dot-com bubble burst. There was the 2008-2009 GFC. There was a short-term reversal in about October 2018, if we remember back to the trade war tariffs days, global economic slowdown worries and the Fed raising interest rates over that period. That there was this short reversal in equities, if you remember back in October 2018. I certainly remember it. And also in March 2020, we had quite a significant short-term reversal associated with COVID. And of course, where we are today, post January 2022, we've got effectively this inflation-related equity impact, where we're getting a significant deterioration in equity performance post January 2022. So there are these 5 periods. And when you look at those 5 periods, you see that the bond, the traditional equity bond relationship certainly held up in 4 of the 5 situations. They haven't held up in this most recent inflation event in 2022. So what we actually find when we drill down into the chart, we actually see the bonds were negatively correlated to equities. They weren't uncorrelated to equities over those 5 events. So when we look at, well, how did trend perform with equities over those periods? You find that in all 5 periods that I've already gone through, you find that in 4 of those periods, trend was actually negatively correlated with equities. And in one of those periods, which was the October 2018 trade tariff war, it was uncorrelated. It wasn't negatively correlated and it wasn't positively correlated, but it has certainly held up better, and it certainly has shown no signs of deterioration from 2000 up to the current day. So as an all-weather allocation into an equity portfolio, it's actually produced superior returns to what the classic 60 equity 40 bond portfolio has done. And when you compare the metrics, I'll just have to get up my screen here, Niels. I'll just compare the metrics and let you know what the difference between the 2 were.
We're all waiting in excitement here for you to find it.
Okay, so when you compare 60% equities, 40% bonds against a 60% equities, and in this case I'm using 40% of the SG Trend Index, is just my proxy for trend following. I find that when you compare the relationship, you see that the compound annual growth rate over the period for the trend solution was 6.91%, and for the equity bond solution was 5.91%. So you actually see that the trend allocation, 60-40 arrangement, actually produces a superior CAGR to what the 60-40 bond did. You also find, now this is the important one, whilst we've got not only a lift in our CAGR, when you look at the maximum drawdown, you see that the maximum drawdown of the trend equity solution is 28%, the maximum drawdown of the bond equity solution is 32%. So we've got an improved maximum drawdown as well as an improved CAGR. So from a risk-adjusted perspective, obviously the trend equity solution improves. So, all the ticks in the box from what Quantica was saying, totally agree with it. But then I thought, well, what is the optimal allocation for the trend equity portfolio? And this is where I used the goal seek function, and I looked at over the last 22 years, what would be a suitable allocation to trend following for a portfolio concentrated in equities. And this is where, in our discussions, we've talked about the benefits of trend following, and where I think allocators fall down is that they are not applying a sufficient or a material enough allocation to trend following to get all of these benefits we're talking about. They will get a degree of this benefit, but it's going to be a diluted benefit. So what I'm saying is that you need to offer a material allocation to trend following to really get these benefits. And what is the optimal allocation? Well, I'll tell you. The optimal allocation from 2000 to 2022.
Can I guess?
Yeah,
I was just going to say, it must be the $64,000 question, right?
Yeah, well, we talked about the 60-40 portfolio. Well, it's a 40-60 portfolio. So the optimal allocation is 40% equities, like the S&P 500 Total Return Index, and 60% SocGen, SG Trend Index. So it flips the relationship around. But what that does, when you compare the results, is that over the 22-year period, the compound annual growth rate for the 40-60 portfolio using trend is 6.81%, which is higher than the 5.91% of the 60-40 traditional portfolio. But where it really clicks in, the maximum drawdown for the 40-60 is 13%, as opposed to 32% for the bond equity. Now, this is where you get this significant benefit, this reduced drawdown from the diversifying properties that we've been talking about of trend following. So I just thought that was interesting to go the next step from what Quantica were doing and apply it to equities and look at this and just test what Quantica is saying, tick the boxes and see what the optimal allocation was.
Yeah, no, I appreciate that. Of course, you didn't quite get my hint because, of course, the actual percentage I think you sent to me was 64. That's why I said it must be the $64,000 question, as far as I remember your notes.
Yes,
but anyways,
it is. It's 64% SG Trend, 36% S&P. Exactly. I just thought I'd sort of round it to being the alternative for the 60-40 portfolio.
I like that. I like that a lot. Well, thanks for that. I mean, obviously, super interesting, and of course, as we mentioned last week or the week before, these type of papers and research papers are super useful because I think a lot of institutional investors will actually have a very hard time arguing against them. Of course, it follows all the other academic papers, over the last 30, 40 years that again confirms that all portfolios need trend. But it's useful to have these updated once every 5 years. Of course, the conclusion is the same, but at least it brings it to the attention of investors. So definitely worth studying. Now, we got 3 topics left. I don't know if we can get through all 3. Let's try, but just be aware of that when you dive into it. So do you want to dive into return stacking, a topic that we've actually talked about a little bit before, but maybe there's some nuances that you want to add to this?
Yes, so this concept of return stacking you'll read about, particularly on Twitter. So what we've been talking about so far is highly related to this concept of return stacking. In fact, for a trend follower, when they're talking about bringing together ensembles of return streams together across asset classes, across systems, etc., they are looking at this principle of the benefits achieved through correlation offsets of bringing those ensembles together, and how they all marry together as a consolidated portfolio, how they marry together in terms of what is the compound wealth delivered by that portfolio with all of these beneficial correlation offsets embedded in them. Now, so the principle of return stacking is something that is applied by people that typically are not 100% invested in trend following. It's typically involved by people that have material dollar exposure to some form of equity portfolio, for example, and they might have $1 million portfolio invested in equities, and that the concept behind return stacking is that you don't need to tie up $1 to get $1 of exposure to any given asset. So futures is a really good product. It's a margin product that lets you get exposure to an asset for 5% or less in margin, which leaves the rest of your capital free to invest elsewhere. So at its core, return stacking is the combination of strategies, and what they do is they use the terms an alpha strategy and a beta strategy. So they're bringing together two strategies together, one that is predominantly ties up the majority of your capital, and the other is a margin-based product that only utilises a small level of capital but gives you significant notional exposure with that investment. So, for example, one of the components, the alpha or the beta, is generally attained through cash-efficient derivatives. So, given that futures require only a small percent of capital versus the gross notional exposure, capital can therefore be used to create multiple exposures. And therefore, what we're doing here is we're applying leverage. But more importantly, whilst we're applying leverage by building on already a high equity level applied to a portfolio plus notional exposure brought in through a leverage instrument, whilst we're adding leverage into the portfolio, we're doing this in a manner that reduces risk. This is important. This is different to, say, someone who scales up their portfolio simply by increasing the position size or increasing the allocations in the portfolio. They're not necessarily doing it in a risk-reducing manner. Return stacking is a principle that's using the benefits of correlation offset to improve the relationship in the most effective way to manage your finite capital. So the idea is that you're using excess money to diversify your portfolio and find returns elsewhere. So let's use an example. If I have $1 million to invest and I get $1 million in bonds, I can also add $1 million in, say, the S&P 500 futures with about 5% margin to gain an additional $1 million exposure. And therefore, when I return stack these components of $1 million invested in bonds and $1 million invested in exposure in S&P, I'm getting $2 million worth of exposure. So it allows you to get this additional exposure to either amplify the return, or you can use return stacking to earn the same return but reduce the risk in that portfolio. So a good example is, just in this example, let's say we return stack the B Top 50 index with a traditional 60-40 portfolio. So when we look in isolation at the performance of the B Top 50, we see that it's got a compound annual growth rate of 7.35%, and a traditional 60-40 portfolio between 87 to 2022 has got a compound annual growth rate of 7.4%. When you return stack something, you're saying we can almost add the 7.4 to the 7.35% to get about 14.75%. It's not going to be exact because when you when you basically add two compound return streams together, there's not an exact linear equivalence between the two. There is some correlation benefits, etc., that alter that relationship, but it's getting close to almost a double the return if you return stack the two on top of each other. So 100% invested in the B-Top 50, 100% invested in a traditional 60-40 gives you 200% at almost double the return. But where the real benefit comes in is that the maximum drawdown of the ensemble of the return stacked arrangement is far lower than what the individual max drawdowns of each individual contribution. So this is where at a gross portfolio level, you get the risk-adjusted return benefits of using return stacking. So it's exactly the same principles, Niels, as we've been discussing in before, but it's just where people who are heavily invested with their cash in a particular portfolio, they can gain the benefits of supplementing their portfolio returns with a return stacked component of, say, trend following, or anything you can obtain the benefits of this margin exposure to get increased notional exposure with lower cash. That's all we're talking about with return stacking.
Absolutely. But let me just, because we've talked a lot about performance numbers, we've talked a lot about leverage. Let me just be absolutely clear that past performance is not necessarily indicative of future returns. And you really do need to understand things like futures before you even dare to, consider something like this. Because, of course, with leverage can also come higher risk. So I just want to make that absolutely clear. In this particular segment. But it is interesting. It's something that is in vogue, of course. And I think the whole theme about how do we replace the 40 in a 60-40 portfolio, I think that is, we started talking about this a long time ago. You and I obviously have written about it a long time ago. So we know it's important. And I think I certainly sense that more and more people are slowly doing it, frankly, not necessarily putting the money in trend following, but they're certainly lowering their exposure to fixed income because when we got to about zero in terms of interest rate levels, I think most people could put the logic together and realize that, well, most likely we're going to be losing money on our bonds, which, by the way, you have done now. If you've had the World Government Bond Index for the last 10 years, you would have lost money, which is a surprise to many people because they still remember the lower interest rates we had for quite a while. But let me just throw in a spanner here a little bit, Rich, something that we should ponder. And that is we currently always refer to, well, maybe we should replace the 40, but given what someone like Niall Ferguson talks about and the future he sees, which is not very bright, and other people are the same, given the fact that we have seen in the 60s and the 70s that even equities had a very long period of time with no returns. We know, and I'm not predicting this, but we know people are worried that we are heading into the perfect storm for equities as well. Which could lead to, it's only 22 years ago we had an 87% drop in the NASDAQ, right? So things can go wrong. So maybe at some point we also need to say, well, how do we replace the 60 in the 60-40 portfolio? I don't have an answer for that right now, even though Jerry and I, of course, touch on the fact that trend following probably is the perfect portfolio, at least in our view. And but
actually, while you're on that topic, I just thought I'd like to add this in that we're about to produce you and me for the next monthly report of the trend following series. So that's hopefully going to be coming out next week. Now, we're adding a little feature segment of that report where we're looking at is there a way to compile a blend of trend following programs to produce optimal portfolio performance? And what we find is that there is enough difference in our trend following world that we can find 100% trend following solutions within the Top Traders Unplugged Trend Following Index, a TTU-TF index. There is enough in that 60 trend followers within there, and enough diversification, enough difference in there to actually create these very powerful blends that I'm finding do produce far more consistent equity curves, which don't necessarily carry all the features of these protracted drawdowns, simply by the way we compile our blends. So the good thing about this is we've got a little solution in this next monthly report, which we use, where we don't use any hindsight bias in our selection process, but we're using a process of selecting each year over a 22-year period the optimal combination based on how they perform as a risk-adjusted composite over the prior 15 to 20 years of history to select them for the optimal candidates each year going forward. Now, what I'm finding is that blend produces these incredible blended results at the portfolio level, which is it's decorrelating the correlations we talk about in trend following, if you know what I mean, and producing quite exceptional returns. So it's something definitely to have a look at because it's a very interesting piece.
Yeah, no, absolutely. Can't wait for us being able to publish that on the TTU website in the near future. Okay, so we have 2 points left, but actually, since we've already been going for about an hour and 5 minutes, I wonder whether we should just keep them for next time, because we do want to have time enough to dive into them with a little bit of detail here. We want to talk about kind of what really matters when we look at data, and that's actually maybe surprising to some people what it is that really matters. And we also want to have a chance to dive into the many different forms that a trend can take. And I think those 2 points deserves enough time. So let's just round the conversation off for today, which of course we hope everyone has enjoyed the insights that Rich shared today. And also, of course, if you want to support the show, feel free to go to Spotify and iTunes and leave a rating and review. Now, next week, Rob is back from his extended summer holiday, I might add. So this will be a chance for him to tackle a few questions that has already come in, but we can load on a few more if you have. So feel free to email them to info@toptradersunplugged.com, and I'll do my best to get Rob's insights to this. From Rich and me, thanks ever so much for listening. We look forward to being back with you next week, and until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.